Hey, everybody. Welcome to this week's Nasdaq Dorsey Wright podcast. We're recording it Thursday, November 17th, putting it out Friday, November 18th. My name is Will Gibson, and we have a special guest this week. Michael, I'm going to go ahead and let you just jump in, introduce yourself to the audience, kind of your background, what you do for Nasdaq.
Sure. I'm Michael Normyle. I'm the US Economist at Nasdaq on the economic research team. I've been here since January, but for the 10 years prior to that was working in macroeconomic research, business cycle forecasting, things of that nature. So it's been an interesting year so far at Nasdaq with how the markets have behaved since I joined. But yeah, it's been a busy year for macro.
Yeah, certainly. I think a lot of people like to talk about macro right now, even if they don't know that they're talking about macro. So maybe compared to other years, just out of curiosity, how is this year compared in terms of what you're looking at in the market? Is it the same? Are you looking at the same things, but just with a more emphasis this year compared to what you've
I
looked at
guess,
before?
yeah, I think it's looking at the same things, but it's just that the extreme nature of it is, for my career, it's kind of unprecedented, really. So, and I think even looking from a historical perspective, where inflation is now, it's something that we haven't seen for 40 years. So it's just been, the same things that you use to gauge the economy are still useful now. It's just that things that have happened in the last couple of years have been so unusual and some without historical precedent, like all the stimulus checks and people sitting on,
Right.
some estimates of consumers having excess savings of over $1 trillion. So like, how do you manage that if you're afraid that there's going to be a recession and yet people have all this money saved up? So it's an interesting time where things that we've never had to deal with before to an extent.
Yeah, I think that's definitely a good point to make. And even as like market technicians, like what we do, right? Right, technical research, we're trying to pull past market events to bring into our current analysis to say that when have we seen prices behave this way before? When have we seen capital markets behave in this particular way? And to your point, you have to look back to 70s, 80s, and stock market data back in the 70s, 80s is sparse, and you got to be really careful because sectors were different back then. So to your point, it's really tough to draw any historical reference to what's going on now, even on our side of the coin from technical research, market behavior. People will say, how valuable is technical research given that you're looking at price past behavior? And if it's unprecedented, how can you really draw any inferences from there? So it's a tough time to be a technician, but also it's a lot of human behavior, a lot of human psychology, people behaving in similar ways in past extreme markets. So at least we can glean some of that. So maybe we can get into some of the things that I know we wanted to talk about today. Some of the major things being themes of inflation. We've seen that come out in recent CPI and PPI reports, which you had some thoughts on. Talk about jobs, talk about housing, and see where we go from there. So, Michael, maybe we start with some of the inflation data points, CPI, PPI, some of your thoughts on that.
Sure. So in the last week, we got a CPI report and a PPI, which is producer prices. And so the big thing that the Fed watches and that news report is the CPI, the consumer price inflation. And so that came in lower than expected, which is kind of a breath of fresh air for everyone, where inflation's been so high and it's been coming in higher than expected. So it came down to, and the core came down to 6.3%. And so those are both off their peaks. Core was at a new peak for the September reading. So October is off that high. And that's something that the Fed is very concerned about, because even though, in our day-to-day lives, we're not experiencing core inflation, which excludes food and energy because they're more volatile, it's still a better sign for where inflation is headed than headline inflation. So even though, we can't just pretend that gas prices don't exist or whatever,
Right.
it's still going to give the Fed an idea where inflation is heading. So that's why it was important to see core CPI come in lower than expected. And of course, headline coming down too is great. So that surprise led, you saw market expectations for what the peak Fed funds rate is going to be. come down. That was about 5.2% for the peak in the Fed funds rate. We're at 4% currently. So it went from a peak expectation of 5.2% down to about 4.9%. But we've seen some pushback from Fed officials in recent days about how we're not talking about a pause yet. We're just talking about slower, smaller rate hikes. So after 4 consecutive 75 basis point rate hikes, we're going to see 50 in December, most likely, which Fed Vice Chair Brainerd kind of signaled recently. And so looking, the Fed doesn't want to speak too far in the future, right? Because everything's data dependent. But so we're seeing smaller hikes ahead, but too early to talk about a pause or a pivot at this point. Even still, CPI data was encouraging. And then PPI, which is the producer prices, also came in lower than expected this week. And an important part of that is the trade services PPI, which is essentially a measure of margin. The pandemic, with all the supply shortages, a lot of companies were able to expand their margins. And now as supply chains have normalized, we're starting to see that reverse. So the PPI for trade services peaked at 19% year over year a few months back. It's down to 11% already. So it's been a pretty sharp drop off. But pre-COVID, it was tended to be very low and stable. And so it should have some more room to fall, which should put downward pressure on inflation. But that's also, if margins are compressing, that's not great for earnings necessarily.
Yeah, it's kind of a tough cycle that we find ourselves in, where if margins come down, to your point, as you're talking about, that's going to hurt businesses, maybe increase layoffs, decrease hiring, slow the economy. But at the same time, that's what people need to see for inflation to come down. So it's kind of like this vicious cycle that maybe there's an equilibrium in there somewhere. Where that is, I guess time will tell. I know we were chatting before about, and you mentioned this now, just trying to forecast out is really tough right now. It's kind of sticking with a trend until proven otherwise. And it seems like, from what you mentioned, the Fed is sticking to that as well. And I know there's been some speculation about them trying to talk down as much as they can, use their voice in a really effective way, and maybe not having to follow through with all of the projected rate cuts. Any added thoughts on that, or does that align with what you were seeing?
I think they have, done a pretty effective job in that. So even though, the talk earlier this year was, how the Fed was behind the curve and so late to pivot, that when they did pivot, they've been very aggressive about the kind of forward guidance that they provided. And you saw markets respond to that. So pricing in the rate hikes before they happened. So to that extent, I think they've done a decent job there, where they have been kind of getting the markets ahead of where they are by providing that kind of guidance. So I think, that's something that has been effective, and they've been using the media and the press conferences that they do to keep everyone kind of updated as their thoughts have changed over time, because they're not putting out their official projections every meeting. So there's, it can be a couple months gaps between getting those kinds of official updates. So they're using kind of the form to let markets know where their head is at currently.
That's neat. No, that's a good perspective. I think, as I mentioned before, and this kind of naturally dovetails some of the jobs specific data that we've gotten as well. I know for most of the year, it was good economic news is bad news for the stock market, except for inflation recently. So if you get lower inflation, that's good news. Stock market, of course, liked that over the past couple of weeks. Jobs have been certainly the opposite, where you get stronger job numbers, market sells off, thinking the Fed's going to have to hike more, et cetera, et cetera. Anything maybe you want to highlight there? Jobs, labor force.
Right. Yeah. I think the first bit of positive news, quote unquote, in the way that the market reacted to it earlier this month was the jobs report, where the economy added 261,000 jobs, which was more than markets were expecting. But the unemployment rate also ticked up. It went from 3.5% to 3.7%. And the Fed, they do want to see loosening in the labor market. And so seeing that unemployment rate tick up is almost kind of like a positive in a sense from the Fed's perspective. Ideally, they would like to see, there's been a lot of discussion recently about the JOLTS data, which has job openings. And so according to the JOLTS data, there's 1.9 job openings per job seeker currently. Pre-COVID, that number was around 1. And so it's incredibly stretched. And so, the Fed would love to see that number come back down to normal and not see a huge, jump in the unemployment rate. But, in a realistic sense, that's probably not going to happen. So there's going to need to be some increase in the unemployment rate for labor market to soften. But given how many job openings there are per unemployed person right now, there is also some scope for just fewer job openings to pick up some of that, or to reflect the loosening in the labor market, where there will be fewer job openings instead of more unemployed people to an extent. So I think it's going to be more of a mix, with job openings coming down and unemployment going up, whereas in the past it'd be more just unemployment going up and doing the kind of heavy lifting there.
That's a tough needle to thread if you're the Fed.
Yeah.
Like, to your point, unprecedented in some ways. I don't know a different market environment, and I'm sure you've studied this a lot more than I have about, is there any type of precedent where this is the case, where you have very low unemployment, very high inflation, and some of the other delicacies where you got to thread this type of needle, or is this kind of one of a kind so far?
I can't speak for the entire history, but I think
Right.
because even the 70s, like with the unemployment rate being 5% a month ago, that was tied for the lowest since the late 60s. So even when the late 70s, early 80s, that the inflation rate was around where it was now, unemployment was higher than where it is now.
Mm-hmm.
So we haven't exactly seen the kind of extremes where we have such high inflation, such low unemployment. So yeah, the Fed's not in an enviable position right here. And a lot of people like to play kind of Monday morning quarterback, where they said, they should have pivoted a year ago,
Yeah.
or before that even. So it's definitely, but they have been pretty explicit in saying that, their goal back to 2%. And if that means a recession has to happen, then a recession is going to happen. That's not what they necessarily want to happen.
Right.
But, Chair Powell, he's said many times that they want to set the economy up for another long expansion, like we saw after the financial crisis, and like we saw after the 2001 recession, where you get these multi-year expansions. The labor market is strong, and everyone can kind of get a job if they want. And so he believes that low, steady inflation is a prerequisite for that. So if the cost of getting back to that point is a recession, it seems from the Fed's perspective. But of course, I think the hope is that we can manage the soft landing scenario.
Right. Yeah. And I remember back in February 20, early March of 20, maybe it was, when you got that like emergency rate cut from the Fed. Speaking to your point, people love to play Monday morning quarterback. I would think they're some of the most in the know people in the world by some extent. They were doing emergency rate cuts before people knew what was happening. I knew there was an analogy going around that I thought was pretty helpful, where you're on an airplane and somebody, it's like one of the pilots comes out of the front and screams to the passengers, "We're not going to crash. Don't worry." No one knew they were going to crash in the first place. So by telling them this seemingly reassuring thing, everybody freaked out. And then I think that's about what kind of happened in the market at the time, where you come out, you get this huge emergency rate cut, and people were like, "What's going on? We didn't expect, why so massive? Why off cycle, et cetera, et cetera." So whole point being that they're probably in the know more than people are aware of. So hopefully they can thread the needle. Soft landing, all of it to be seen. I guess history will be written as we're living through it here. Last third point. I don't want to keep you too long today. I know you have a lot of things to do. Housing, that's another dinner time conversation topic. It seems everybody wants to talk about how much equity they have in their house, or they want to talk about the interest rate they got 2 years ago. That's also very close to home for a lot of people I know, in terms of personal consumption, shelter expense. That's a big outflow for people every month or every year. So any type of light you want to shed on that, things you've seen. I know you've written about that internally to the Nasdaq group as well.
Yeah, I guess the first thing to say is that this is kind of the sector that's been most acutely affected by the Fed's rate hikes so far, since it's so dependent on what mortgage rates are, and we've seen them go up from they were just over 3% at the end of last year. Now they're over 7%. So seeing that kind of spike is of course going to impact housing demand. We've seen starts are down something like 20% since I think April. So there's been a really sharp decrease in demand and activity in housing. There's still room for, I think, prices potentially to come down further. But it seems like with markets having priced in a lot of what the Fed is planning on doing, unless there's some shift that we don't see coming down the road here, then mortgage rates have probably done most of the adjustment that they're going to need to do this cycle. All that said, I think we're not necessarily in for a 2007 style housing bust here. Back then people could get adjustable rate mortgages, no money down, all that kind of stuff, subprime mortgages.
Right.
And in the period since then, almost all the mortgages have been going to very creditworthy individuals. A lot of people have significant equity in their homes. So I think that, any potential fears of a housing buster would be, overstated. And so that's a bit of reason to not worry too much about the current housing situation. But of course, yeah, no one wants to hear that the value of their home is going to go down. And certainly that there's been a big chilling effect from the Fed rate hike so far. And there's probably some more room to run. You saw there's survey that just came out, I believe yesterday. It's gone down for 11 straight months. It's the worst it's been since April 2020, which of course was the depths of the pandemic. So home builders themselves are pretty negative on what the housing market looks like currently too. And there's of course supply issues where we've actually seen supply of new homes expand pretty quickly, but existing homes are still, there's still not a ton of supply there. And if you have a 3% mortgage rate, you're maybe not incentivized to buy a new house. So at 7%. So that's definitely an issue where there's got to be some kind of adjustment here for supply and demand and prices in the housing market.
That's a good perspective. And to your point about people having all these low interest rates and not wanting to upgrade, keeping I guess that'd be existing supply very low. I know my wife constantly sends me homes on Zillow, but I'm telling her, I'm like, we have a 3% interest rate. We are never selling this house. But I don't think she cares about that as much as I do. So I'm sure we'll sell our house at some point and move. But no, that's really good. Let's see, any final thoughts? I think we kind of hit all the notes that I had. Any kind of takeaways, things to look for the audience to watch?
Yeah, I think, the next Fed meeting that we have is in December. And between now and then, we're going to get another jobs report and another CPI report. And so I think those will go a long way to either solidifying the 50 basis point rate hike that's expected in December, and possibly what's going to happen beyond that. So I think a response from the Fed officials to the latest CPI report is, you can't focus too much on one number. So we need to see multiple months of this to kind of get the Fed on board with the idea that inflation is coming down in a persistent way. So I think that's something that'll be important, certainly to markets and just in general with where the Fed is going to be headed soon.
That makes sense. Yeah, even on the market side, which tends to be a leading indicator, if that's correct. So capital markets, we're saying the same thing. We want to see some follow through given the run that we've had recently. And I guess your point on the economic front, you also want to see some follow through of lower inflation coming down and maybe some follow through on Fed speak as well coming into the end of the year.
Yeah, and I think the jobs numbers that we've gotten, especially with jobs added, are higher than would be kind of consistent with inflation coming down. So we want to see the number of jobs added come down, but not go negative where we're kind of talking about a recession at that point.
Right. Right. That makes sense. Well, I know there's a lot to talk about here. Maybe we'll have you come on again next year, share your thoughts again. Michael, thanks for your time. Thanks everybody for listening this week. If you have any questions for us, don't hesitate to reach out.
Great. Thanks for having me.